Okay, hello and welcome everyone. So in this video I'm going to talk about market demand. In the previous video I talked about individual demand, that's why I'm leaving off right here or picking up right here. So with the individual demand, we're thinking about the shape of your individual demand curve by saying at a given price, how much are you willing to buy? Then we thought about applying the core principles of economics to make good demand decisions. This basically gave rise to the rational rule for buyers, which is like keep buying as long as your marginal benefit is bigger than the price, and then stop buying at the point where your price exactly equals your marginal benefit. Well, and then this gives rise to the idea that the theory of marginal benefit is the theory of demand. That your demand curve and your marginal benefit curve are one and the same. All right, so now we want to think about aggregating up individual demand curves to give us the overall market demand curve. And we want to think about what shifts demand curves. This is going to be a change in demand. And then we'll think about distinguishing between shifts and movements along demand curves. So movements along demand curves correspond to a change in quantity demanded. All right, so what's the market demand curve? Well, the market demand curve is the graphical representation of the demand relationship. The demand relationship is going to be the collection of all pairs of price and quantity demanded. So name a price, there'll be a quantity demanded, right? And then if you see this in table format, that's the demand schedule. If you see it in graphical format, that's the demand curve. Whether or not it's actually a straight line, or whether or not it's actually a curved line, it could even be a straight line. We'll still call it a demand curve. That's just the terminology. All right, so individual demand curves are the building blocks for the market demand. We just aggregate them up. So here's how you could estimate market demand. First, survey customers. Ask each person the quantity they'd buy at each price. Then add up the total quantity demanded by your customers for each price. Then scale up the quantity demanded by the survey respondents, so they represent the whole market. And then plot the total quantity demanded by the market at each price, which gives rise to our demand curve. Right, so basically we're just going to aggregate up so we get the market quantity demanded at a given price. So here would be an example. So firstly, we'd run a survey. So this is like the gas example. Okay, so we have Darren's demand, we have Brooklyn's demand, we have a bunch of other people. So Darren's demand, we saw that already. Here's Brooklyn's demand and everybody else's. And what we're doing is we're adding up everybody's quantity at the given price, right? And if we add everybody up, and then suppose we scaled it up to represent the entire population, then we get our total market demand. Well, yeah, if we're thinking that we have a population of 300 million people who are demanding gas, that'd be our total market demand. Okay. But that's the basic idea. At a given price, we're going to take each individual quantity demanded, sum them up to get the market quantity demanded. Well, sum them up, multiply, scale to represent, in this case, the million people. Total demand across 300 people, scale up to get to 300 million people. Here is our market quantity demanded. All right. So our market demand curve would be at a price of $1, the market quantity demanded is 2.8. Price of 2, the market quantity demanded is 2.4, so on and so forth. All right, so suppose we're doing this for the United States. We want to representative sample the market, ask each person what quantity they buy at every price, and then we sort of scale up. So that's the idea, and that was what we had from before. And then here's just plotting those points. So this on the left would be our demand schedule. This on the right is going to be the market demand. Right? All right. And then we can connect a line. And this gives rise to sort of our representation of what must happen at other intermediate prices. As I said in the other video, it might not be exactly perfectly linear between here. Now, that's okay for our purposes. We'll draw straight lines to represent demand because what we're interested in is kind of what the model's going to be able to give us. Basically thinking about, well, what happens if price changes? Quantity demanded rises or falls. What happens if something other than price changes? It's going to shift left or shift right. And we can actually see those things more transparently with the straight line demand curve. All right. So the market demand curve is downward sloping. Why? Because of, well, the law of demand that we introduced earlier, meaning the total quantity demanded is higher at lower prices. So the idea, though, is thinking about what's happening as price changes. So as price changes, we're getting either a higher or lower quantity demanded, and there's kind of two ways that this effect happens. So in the reading, Betsy and Justin call this the extensive margin and the intensive margin. So when prices are low, current customers buy more gas. That's the intensive margin, right? Current customers buying a greater intensity, right? When prices are low, the number of customers increases. That's the extensive margin. The extent of the market increases, right? So those are the two effects, both giving rise to a higher quantity demanded. Interestingly, when lower prices fall, people in the market already buy more, and when prices fall lower, people who weren't previously in the market then join the market. Now that's going to be really important as we're thinking in the future, especially analyzing policy changes. Because when the price rises or falls, the effect on people isn't going to be the same. Different people are going to be affected differently. There's a very different story behind if the price falls and you're able to buy more, to the situation where if the price falls and now you're able to afford it in the first place, right? Those are two very different circumstances. Or when the price rises, now you can afford less, versus the price rises, now you can't afford any at all and you leave the market, right? Those are two very, so here, that like on the slides, Justin's just using this to explain law of demand. But I want to foreshadow for the future, which is that this intuition is actually really important when we think about actually applying the model and thinking about like what happens when prices change and how this ultimately we're interested in like how this actually affects people. Okay. So suppose you and your 99 classmates all have identical marginal benefits for coffee. The marginal benefit of the first cup is 4, marginal benefit for the second is 3, the third is 2. If the price of coffee is 3, what's the quantity demanded in the market? Oh, well, we did this already, right? If the marginal benefit is 3 and the price is 3, you buy, 2? But we have 99 people, so 2 times 99? Okay, best answer is 200. Oh, you and 99. I forgot to count myself. So 100 times 2, right, is 200. Anyway, so here's our movement along the demand curve. So the movement along the demand curve is going from one point on the demand curve to another point, right? So if price falls, we get an increase, a rise in quantity demanded, right? We're moving down the same market demand curve. We get it when the price changes, we get a change in quantity demanded. The really important thing we got to reinforce here is that if price changes, only quantity can change. If price changes, only quantity can change. If price rises, quantity demanded falls. If price falls, quantity demanded rises. We'll have something very similar for supply. Actually, turns out if price rises, quantity supplied rises. If price falls, quantity supplied falls. In order to get demand or supply as a whole to change, we need something other than price to change. That's what this is going to be. What shifts demand curves? So we want to think about remembering the interdependence principle, which I haven't been talking about to this point. Interdependence principle reminds us buyer's choice depends on many other factors. So remember, a shift in the demand curve, that's a movement of the demand curve itself. An increase in demand is going to be a shift of the demand curve to the right. A decrease in demand is going to be a shift in demand curve to the left. Right? So if an increase in demand, we're going to draw a rightward shift. If we have a decrease in demand, we're going to draw a leftward shift. All right, so here's our pictures. So we have an increase in demand. That's a rightward shift. And notice what's happened. Going from the old demand to the new demand, we have an increase in demand. We're going to get a larger quantity at every single previous price. Right? So let's find a price, $4. Find the quantity on the original demand curve. I don't know. It looks like maybe 175. Now find the quantity on the new demand curve. Oh, looks like maybe 275, right? 1.75 and 2.75. Or let's look at actually this point. So at $2, I don't know. To me, that looks like about 2.4, 2.3, right? And then on the new demand curve, that looks like maybe 3.3 or 3.4. So basically, though, we're getting an increase in quantity at every single price with our increase in demand, and the reverse for a decrease in demand. We're going to get a smaller quantity at every single price. So what could do this? Well, think about like Darren and demand for gas. So suppose Darren got a less fuel efficient vehicle. Now at every price, Darren's going to be willing to buy a larger quantity, right? Suppose Darren gets a more fuel efficient vehicle. Now at every price, Darren's going to be willing to buy a smaller quantity. Okay. What shifts demand? Well, factors that shift both the marginal, the individual, and the market demand curve are things like income, preferences, prices of related goods, expectations, congestion, and network effects. So network effects, that's just a situation where the demand for the good is dependent on how many other people are on the network, right? So like Facebook, social media, these are all network goods. The value that you get from having an Instagram page or whatever is going to increase the number of other people that are also on that same app, right? Congestion would be if my value decreases as more people join, right? So how much am I willing to pay for a toll road? Not much if it's really congested, right? All right, so factors that shift only the market demand, this would be a change in the type and number of buyers, right? All right. So the first demand shifter, income. If income changes, we actually have some work to do. We have to determine, is this a normal or an inferior good? If it's a normal good, this means at higher incomes, there'll be an increase in demand. If it's an inferior good, this means at higher income, there'll be a decrease in demand. So here's an example of like normal and inferior goods. So in 2007, Target's stock price was higher than Walmart's. Well, the economy entered a recession in 2007. Walmart sells inferior goods, so a decline in average income raised their sales and the stock price rose. Target sells normal goods, so falling average income led to a decrease in demand, so their stock fell. I mean, the other way to kind of do this is to go in the other direction. I know what they're doing here. I know what Betsy and Justin are doing here, but my logic would probably go in the other direction, which is if there's a decline in average income and we see an increase in demand for increase in sales at Walmart, from this we say this is consistent with Walmart selling inferior goods. If we see falling income and people buy less at Target, that's consistent with Target selling normal goods. But it's just kind of what two ways to approach the same logic. All right. So think about your preferences. Well, changes in your preferences can shift demand curves, right? Companies spend billions of dollars for advertising. Social pressure shifts your demand curve. Also fashion trends. All right, so these are all things that affect your tastes and preferences. News reports. If it turns out that, like health news reports, if it turns out that there's, positive research results coming, health effects for coffee or caffeine or whatever else, this affects your demand for things. So, all right. Demand shifter 3, so prices of related goods. So changes in the prices of related goods can shift demand curves. So complementary goods are goods that are used together. Substitute goods are goods that are used in place of each other. I've got another video. If you search in the search thing and look for complementary or substitute goods, I go through with graphs and I show kind of really carefully. And so you could see that as well. But examples with complementary goods, think of like hot dogs and hot dog buns. Substitute goods, these are things like driving versus walking, taking Uber, so on and so forth. All right, so imagine that you want to buy a sandwich and you're wondering whether to buy a chicken sandwich or a grilled cheese sandwich. What type of related goods are these? Well, for most people, these are probably substitutes. What factors could affect your influence to buy one or the other? Well, the price of chicken sandwich might affect so here's the graphs that I build out in my other video. So if the price of a chicken sandwich rises, I buy a smaller quantity of chicken sandwiches and it increases my demand for grilled cheese, right? So when the price of one good changes, when price changes, only quantity can change for the good under consideration, and then demand for the other thing changes, right? So the change of price affects So it's the price of the chicken that has a different price. It's chicken. It's the price of chicken that has a different price. So the chicken sandwich gets a different price. So I'm going to get a different quantity for chicken sandwich. However, relative to grilled cheese, they're substitutes, and so we'd expect a change in demand for grilled cheese. Or who knows, maybe they're complements, depending on what your preferences are. What factors can influence your decision? Yeah, just prices. So which of the following are not substitutes? Car and gas, right? They're not directly substitutes. So yes, you could have a Tesla and then gas and electricity would be a substitute. But here, for just thinking like literally a car and a gas, those are not substitutes. We always want to look for the best answer. Bus and train, yeah, those are substitutes. Pen and pencils, those are substitutes. Hamburger and veggie burger, presumably those are substitutes. So, all right. Now let's think about demand shifters, expectations about the future. So if you believe prices might rise, you'll make your purchase today, which increases today's demand. If you believe prices will fall, you'll delay your purchase, decreasing today's demand. So the idea is, if you have different expectations about what will happen in the future, this changes what you do at the time you receive that news. So it's really important to kind of keep this clear. If I believe the price of something is going to rise in the future, I might want to buy it today so I don't have to pay as much, right? If I believe the price of something is going to fall in the future, I'll buy less today, I'll just buy it later on. That's how we deal with changes in expectations about the future. All right, so congestion and network effects. Network effects, so this is the effect that occurs when a good becomes more useful because other people use it. So if more people buy such a good, your demand for it increases. Yes, we think of like popular social media platforms. Congestion effect, this is where the good becomes less valuable when other people use it. So it'd be like roads or something like this, right? So if it's really congested, really crowded, maybe I'd just rather walk than bother with driving if it's a short distance. All right, type and number of buyers. So if the composition of the market changes, this will also affect demand. Market demand increases over time as population grows, right? So if there's more, so remember what demand's doing. Demand's the relationship between price and quantity demanded. An increase in demand means a larger quantity at every price. Well, if there's more people, there's going to be a larger quantity at every price, right? And so here we're expecting the type and number of buyers can be an important shifter. So you think of like what's happened to the U.S. population. In 1950, there's 152 million. 2015, there's 321 million. Really? I thought there was only 300 million. By 2060, there'd be 417 million. Okay. All right, so good. This means that we have a lot of like increases in, so we have a sort of big increase in the number and type of consumers, especially thinking like demographic trends, and how this might vary across different markets is actually kind of really interesting. So we have like growing markets, and we have, with a lot more consumers, you've got a lot more consumers within which to find a niche for whatever is going to be your product. So interesting. Okay, so which of the following would change the market demand curves without shifting individual demands? Well, that's the number of buyers, because this refers to the entire market as a whole, not to individual demands. All right, the last thing, let's distinguish between shifts and movements along a demand curve. All right, so a simple guideline. When the price changes, you're thinking about a movement on the demand curve. When other factors change, you need to think about shifts. If prices change, only quantity can change. In order to get demand or supply to change, you have to have something other than price to change. All right, so the first thing, when the price changes, we have a movement along the demand curve. So a change in price from $4 to $2 per gallon. When the price falls, so we end up getting a larger quantity demanded. So like I said, the way that Justin explains this and the way that I've adopted is to say, hey, your demand or the market demands, that's a set of plans. It's plans involving what to do at different prices. Okay, so if the price changes, what do? You follow your plans, you execute those plans, and you use a different quantity. If something other than price changes, now you need a new set of plans, right? And so then we get an entirely different set of plans. That's a new demand curve. All right. So, yeah, we get a change in price from $4 to $2. That's a movement along the demand curve. That's a change in quantity demanded. All right. Good, good, good. Now for the shift, when other factors change, we get a shift in the demand curve. So a decrease in demand shifts the demand curve to the left, decrease in the quantity at each and every price. So this would be like a decrease in the number of buyers. So people leave the market, we'll get a leftward shift of the demand curve. That's like a college town when people go home over the summer, right? Or a college town where people don't come back to the college town because of pandemic, right? Leftward shift in demand, right? So, all right. And then an increase in demand. So pandemic's over and everybody returns to campus. All right. And then last question. So which of the following would decrease the quantity demanded? Oh, which would decrease the quantity demanded and increase in price? Don't even need to look at the choices. So an increase in the price of a complement, nope, that'll shift. So an increase in the price of a complement, that's a good used with the good under consideration, will decrease the quantity demanded of the complement, so then this will decrease the demand of the good under consideration. That'd be a leftward shift of the demand curve. An increase in the number of buyers, that would be a rightward shift of the demand curve. An increase in the expected future price, that would be a leftward shift of the demand curve. I'd buy less today regardless of the price because I'm going to expect the price, sorry. Be a rightward shift of the demand curve. I'm not going to edit that out. So an increase in the expected future price means I'm going to get a rightward shift in the demand curve because it's going to be more expensive in the future, so I'm going to buy more today, right? So it doesn't matter the price. I'm going to buy a lot more today because I believe it's going to be way more expensive in the future. And then the one that we were trying to talk about, which would decrease the quantity demanded, a movement along the demand curve, and increase in the price today. All right, our takeaways: individual demand is the quantity an individual is willing to purchase at every price, holding other things constant. Individual demand is determined by using the core principles: marginal cost, cost benefit, and opportunity cost. Rational buyers purchase the quantity where price equals marginal benefit. Oh, if they purchase a smaller quantity, they should purchase more because the smaller quantity would be where price is smaller than their benefit, right? So they could get an additional gain by buying more. If they bought a larger quantity, now they've got a situation where the price is higher than their marginal benefit, right? Market demand curve is the sum of the individual demands at each price. And then changes in price lead to movements along the demand curve. That's a change in quantity demanded. Changes in factors other than price shift the demand curve, right? All right, very good. I hope you enjoyed the video, and I'll see you for next time.